Hello, families. Welcome back to the American Family Survival Network. I'm your host, Jeffrey Snipes. Dangerous Bubbles in Plain Sight. This comes to us by David Stockman, ContraCorner.com. Okay, Jesse Felder published an incisive bubble finance chart over the weekend. It is yet another reminder that Janet Yellen and her merry band of money printers are oblivious to the dangerous speculation and valuation excesses that their policies have implanted throughout the financial system. Relative to disposable income, the value of household financial assets now far exceeds the last two bubble peaks, and that has happened in an economic environment which suggests just the opposite. To wit, valuation multiplies and cap rates should be following, owing the fact that the productivity and growth capacity of the U.S. economy has been heading south ever since the turn of the century. Household financial assets relative to disposable income. So here we're looking at the dot-com mania, the real estate bubble, and the everything bubble, which we're currently in. What is even more striking about this chart is what's hidden behind the denominator. Since the eve of the financial crisis in 2007, a rapidly increasing share of DPI, otherwise known as disposable personal income, has been accounted for by the explosive growth of transfer payments. Needless to say, transfer payments do not represent newly produced income that can be capitalized into the value of aggregate societal wealth. By definition, transfer payments are extracted via taxation from the incomes of current producers or via taxation of future incomes if they are funded with increased government debt. Either way, the true extent of the bubble excess in Felder's chart is even more extreme than pictured above. Between 2007 and 2016, in fact, the value of household financial assets soared from $53 trillion to $72 trillion. At a time when real personal income, excluding transfer payments, rose by only 1.2% annually. And that's crediting the BLS, Bureau of Land Statistics, or Labor Statistics, deeply understated inflation indices. In the real world of flyover America, inflation-adjusted earned income hardly grew at all. So we're looking at the societal benefits as a percentage of real disposable income, and social benefits as a percentage of real disposable incomes are at the highest levels on record. And down here you see the total increase in government benefits in the billions. So you can see down here at 2000, I guess that's the same time period, but you can just see that it's a skyrocket. It just says skyrocketed up. Interesting. And then you can find out more about these charts at realinvestmentadvice.com. So here's a news flash for the clueless school marm. I'm not quite sure what a marm is. Maybe that's a typo. Maybe that's the clueless school mom who presides over the Wall Street casino. There's no such thing as a timeless, quote-unquote, historical norm when it comes to the valuation of financial assets. The appropriate capitalization rate for a current stream of income or cash flows depends upon the expected growth path into the distant future. I would not say that asset valuations are out of line with historical norms, and that's according to Federal Reserve Chairwoman Janet Yellen. She said that on September 21st, 2016. Yet, by the Fed's own reckoning, the expected growth rate of the U.S. economy has been marked down time and again in its economic forecast. The long-run median real GDP growth rate is now pegged at just 1.9%. So you might think that someone on the Fed would connect the dots. For the last 6 years running, they have drastically overestimated the growth of real GDP, even as the stock indices have soared based largely on multiple expansion. Thus, after estimating 3.7% growth in 2011 and nearly 4% growth in 2012, actual expansion came in at 1.7% and 1.8%, respectively. Yet that wasn't some kind of temporary aberration. During 2013 and 2014, the shortfall between initial estimates and actual was also nearly 50%. And then, even as the Fed lowered its estimates for 2015 and 2016, the actual rate of growth slowed still more. In the case of anyone paying attention, anyone paying attention out there? Of course, the tepid and weakening recovery conveyed in the table below helps explain why S&P 500 profits peaked 6 quarters ago in the September 2014 LTM period at $106 per share. Since they came in 19% lower at $87 per share in the June 2016 LTM, the actual market multiplier at 24.7x is anything but normal. And that's hardly a temporary condition either. As was indicated, as if you needed that either, right? Okay. As was indicated in a nearby post, the Wall Street hockey stick is bending towards the flat line yet again. The most recent earnings outlook for Q3 has turned negative on a year-by-year basis, just in time for the next earnings season, and also precisely as needed for another round of Wall Street's phony earnings quote-unquote beat game. In short, in the context of declining earnings, PE multiples are not even in line with historic norms. Contrary to Yellen's press conference blather, they are at the very top of the charts. Worse still, the Fed continues to project that interest rates will normalize, back to 3% on the federal funds rate and 4.2% on the 10-year Treasury note. And in point of fact, sooner or later, that must happen or the entire monetary system will be destroyed. So with the future outlook characterized by slowing growth, weakened earnings, and rising interest rates, how in the world can it be said that current valuations are nothing to worry about? So here we go. Here's another chart for you. This here shows estimates. This is FOMC economic projections. That's what they're projecting. That looks like a big arrow down. And then you've got the GDP estimates versus actual from 2011 to 2017, all going down. The gross domestic product all going down. Okay, so at the same time, even the Fed's new dissenter, the formerly dovish Eric Rosengren, remains lost in the Fed's Keynesian puzzle palace. Rosengren voted to raise interest rates because he apparently thinks the U.S. is nearing full employment. Ha! What a joke! And that it may overshoot by 2019, thereby creating inflationary risk. What planet are these people on? By 2019, I expect the unemployment rate to have declined below 4.5%. While I have a long track record of advocating for policy that supports robust labor market conditions, that is below the rate that I believe is sustainable in the long run. Well, that's some kind of full employment, quote unquote. There are 5 million more prime working age persons in the U.S. today than there were in January 2000. But the number with jobs, including part-time gigs, a few hours per week, and self-employed eBay traders, is nearly 1.0 million lower. As for inflation, here is another news flash. It's already here. Median rent inflation year by year, 4-quarter blended average. Now that looks like it went up. Yeah, inflation. Okay. So here's the danger. Be careful. There be danger nearby. The denizens of the Eccles building see no bubbles in a financial system that is rampant with asset inflation. Bubbles. It sees full employment when the U.S. economy has more labor slack than any time in modern history. And it keeps the Wall Street gamblers in the free carry trade funding because it wants even more inflation than what it is already ravaging the real incomes of flyover America. That'd be you and me. David Stockman, ContraCorner.com. Thank you very much, folks. So, folks, what that means is it's about to get bad. And you need to go to the AmericanFamilySurvivalStore.com for all your family's emergency and survival needs today. Remember, protect and safeguard your family. God bless, and fear not. Thank you.